One fund charges you 0.03% per year. The other charges 0.75%. Both own the exact same 500 companies. Both track the S&P 500. One trades like a stock all day long. The other only prices once after the market closes. They look identical on the surface, but the mechanics are completely different. Both ETFs and mutual funds are investment vehicles that pool money from many investors to buy a diversified basket of stocks, bonds, or other assets. That part is identical. The difference is in how they're bought and sold. An ETF or exchange-traded fund trades on a stock exchange throughout the day, just like shares of Apple or Tesla. You can buy or sell shares at any moment the market is open, and the price fluctuates minute by minute. A mutual fund, on the other hand, only prices once per day after markets close at 4 p.m. Eastern. Everyone who places an order that day gets the same end-of-day price, called the net asset value, or NAV. You're not buying from other investors. You're buying directly from the fund company. According to the Investment Company Institute, the average equity mutual fund charged an expense ratio of 0.44% in 2023. The average equity ETF charged just 0.16%. That's the annual fee you pay as a percentage of your investment. On a $10,000 investment, that's the difference between paying $16 per year versus $44. Over decades with compound growth, those gaps add up substantially. Historically, ETFs have been cheaper because their structure requires less administrative overhead. No daily redemptions to process. No shareholder services department fielding phone calls. Most mutual funds require a minimum initial investment, often between $1,000 and $3,000. Some retirement account versions waive this, but if you're opening a taxable brokerage account, you typically need that chunk of cash up front. ETFs have no minimums beyond the current share price. If an ETF is trading at $85 per share, that's your minimum. You can buy one share. Many brokerages now offer fractional ETF shares, meaning you could invest $20 if you wanted. This makes ETFs more accessible for people just starting out, or those who want to dollar-cost average small amounts each paycheck. In 2022, about 65% of actively managed mutual funds distributed capital gains to shareholders, according to Morningstar. This happens when the fund manager sells winning stocks inside the fund. You get taxed on those gains even if you never sold your shares. ETFs rarely distribute capital gains because of how their creation and redemption process works with large institutions. It's called an in-kind transfer mechanism. Over a 30-year period, the tax drag from mutual fund distributions can reduce after-tax returns by 1 to 2 percentage points annually for funds held in taxable accounts. Take two funds tracking the S&P 500. The Vanguard 500 Index Mutual Fund, VFIAX, has an expense ratio of 0.04%. The Vanguard S&P 500 ETF, ticker VOO, charges 0.03%. Both own the same stocks in the same proportions. Over 10 years on a $10,000 investment, assuming 10% average annual returns, the mutual fund would grow to about $25,736 after fees. The ETF would reach $25,768. That's a $32 difference from just 0.01% in fees. Now add in potential capital gains distributions from the mutual fund, and the gap widens. Many investors hold both in different account types based on which structure fits better. ETFs give you intraday trading control. You can buy at 10 a.m., sell at 2 p.m., set limit orders to buy only at a specific price, or place stop-loss orders to automatically sell if the price drops below a threshold. Mutual funds don't offer any of that. Your order executes at the end of day NAV, no matter when you place it. For long-term buy and hold investors, This distinction matters very little. But if you want the ability to react to market movements or use trading strategies, ETFs provide that flexibility. The trade-off is you might pay a bid-ask spread, the difference between buying and selling prices, which mutual funds don't have. As of 2023, ETFs held over $7.6 trillion in assets in the United States. Mutual funds still dominate with over $23 trillion, but the growth rates tell the story. ETF assets have grown by more than 300% over the past decade, while mutual fund growth has been relatively flat. Money is clearly flowing toward the ETF structure, driven by lower costs, tax efficiency, and the flexibility younger investors expect from their investment platforms. Inside a 401k or IRA, the tax advantages of ETFs mostly disappear because these accounts are already tax-deferred or tax-free. Many workplace retirement plans only offer mutual funds anyway, not ETFs. In that context, some people choose mutual funds because they can set up automatic investments of exact dollar amounts, like $200 per paycheck. ETFs require buying whole shares unless your brokerage offers fractional investing. Target date retirement funds, which automatically adjust their stock-bond mix as you age, are almost always structured as mutual funds. Both vehicles work well in retirement accounts. The choice often comes down to what your specific plan offers. Both mutual funds and ETFs can be either actively managed or passively indexed. An actively managed fund has a manager picking stocks trying to beat the market. A passive index fund just tracks a benchmark like the S&P 500. Historically, most ETFs were passive index funds, and that's still the majority. But actively managed ETFs are growing. Most mutual funds are actively managed, though index mutual funds from Vanguard, Fidelity, and Schwab are hugely popular. The active versus passive decision is actually more important than the ETF versus mutual fund structure when it comes to long-term returns. Some people choose mutual funds for employer retirement plans where that's the only option, or when they want to automate exact dollar amount investments without thinking about share prices. Others prefer them for certain actively managed strategies not available as ETFs. Many investors pick ETFs for taxable brokerage accounts because of the tax efficiency and lower fees. The ability to trade throughout the day appeals to some, though most buy and hold investors never use that feature. Plenty of people own both: a target date mutual fund in their 401k and a few ETFs in their Roth IRA. Neither structure is inherently better. It depends on your account type, investment goals, and whether the features of one structure align better with how you actually invest. The core distinctions come down to trading mechanics, cost structures, and tax implications. ETFs trade live on exchanges with typically lower fees and better tax efficiency. Mutual funds price once daily, often have investment minimums, and may distribute capital gains. Both can track indexes or be actively managed. The structure you choose matters less than picking low-cost, diversified funds that match your goals. Where you hold them, your investment timeline, and the specific fund quality matter more than the ETF versus mutual fund label. Everything covered here is for educational purposes only. This is not financial advice. Every situation is different. Consider speaking with a licensed financial advisor before making any major money decisions.